Now, here is Ticky Fullerton on Your Money.
Hello there, I'm Ticky Fullerton, every night bringing you a full hour of the very best in business coverage across the nation and internationally, especially where business and politics meet. They have again today. Well, Angus Taylor, the Energy Minister, pitches us the Prime Minister's new energy and climate change cash splash and what the new cap on the default electricity price will mean for punters and big energy companies. Oh, and why the ministerial outrage at AGL's half-yearly results. Remember that? BlueScope delivers a record half and blue sky for its US business. CEO Mark Vassella runs through his results and who should get the next big iron ore delivery contract for Port Kembla. And a big red light on Santos's Narrabri gas if New South Wales elects a Labor government. Credit Suisse analyst Saul Kavonic explains why not just Santos, but also the union might be very unhappy about Labor's sudden new position. Well, speaking of sudden, we woke up to a new bank levy threat this morning, this time from federal Labor. Anyone would think there was an election on. Flagged last week, actually. The levy means that banks will be hit with an extra $640 million under a Labor government, a new fairness fund to bail out customers who've been done over by the big banks. Actually, it's a few more than the big four, any financial institution big enough to be in the ASX 100. Well, Labor's Financial Rights Fund will also cover doubling of financial counsellors on call, but much more detail on how the fund works on the remediation side is a little hazy at present, I think. It comes on the back of Labor's announcement on Friday that it would offer a much more generous scheme for victims than the government, up to $2 million. Well, of course, it's yet another message for the big four, in particular that the bank bashing is far from over. The big scalps so far are Ken Henry and Andrew Thorburn, Chairman and CEO of NAB, who are now looking for... Ken Henry is now looking for replacements. We actually thought Ken Henry would be driving this, but on reflection, the bank has decided that passing the selection process over to two NEDs on the board would be a much better look. And Sherry will be in charge of the CEO pick, and speculation is rife. The AFR is tipping Craig Drummond from Medibank and three internals, Mike Baird, who just got his sleeves rolled up running the retail bank, Angie Mentis, who now runs the New Zealand operation, and Anthony Healy. But we reckon there might be a few more contenders in this new climate where clean skins have such cachet. Well, I set the scene there. For more, Your Money's chief business reporter Leo Shanahan joins me live at the desk. And we're also joined by banking and insurance analyst David Ellis from Morningstar in our CBD studio. Gentlemen, welcome. Leo, let me just ask you about this new levy. Where do we think this is coming from? Well, obviously, it's an election thing.
Yeah, well, it was basically flagged last week, as you said. It's there to fund this increased promise that compensation would be associated with this new body run out of the Australian Financial, the AFCA. So, look, it's not surprising, really, that this money's been promised. I mean, the question is, have we kind of hit peak bank bashing? Are we there, that dueling banjo stage where we're finally there? I keep thinking we got there and we're still not there.
I'm not sure we have at all. We've got to go through all the asset cases.
Yeah, well, obviously this goes to what Labor promised under this new scheme, which could also be, these could be cases that could be revisited, that the court has already heard, that the Ombudsman's already heard, and you could then return to this new AFCA body that's on top of already a review board that AFCA have.
So this is a board above AFCA?
Yeah, well, it would be an independent board that would be then separate from the Ombudsman or the AFCA that we already have.
Yes.
And individuals would be eligible for up to $2 million, $1 million each, mind you. So you could get $1 million on compensation.
Yes.
You could also then get $1 million for emotional and other types of damage that's been done to you. Look, ultimately, that scheme, it's pretty big and it's pretty generous, but you need a scheme like this because, A, the public are crying out for it, and really it's going to stop a whole bunch of other litigation, I think.
But is it capped? Is it capped?
Well, it's capped at about $2 million for an individual.
Yeah, and you think that $640 million will be all right? We'll cope with that, do we?
Well, you'd think so, and it's actually the banks, as far as the banks go, it's not that much money.
Well, let me bring David Ellis in here.
$160 million.
David, what do you think of this latest levy, how will it be received by not just the big four banks, but, as I was saying, other financial institutions? And is 640 million a huge hit?
Well, looking at it from bank shareholders or investors' point of view, it's insignificant. You know, you look at the profits, the combined profits of the four major banks. You know, say it's 30 billion per year after tax. You know, even if they contribute the majority of this supposed $164 million a year, it's peanuts as far as the impact on bank profitability is concerned. And as you pointed out, Ticky, it's not just the four major banks, it's the all financial institutions, I think, I understand, in the ASX 100. So it includes the big wealth managers as well. I guess and the regional banks.
I guess what might be slightly disturbing is that, you know, the original bank levy came in. That really wasn't about remediation. That was a budget exercise in the end, wasn't it? But all these levies, they come in. And as you say, if they are relatively insignificant compared to the big bank bottom line, what is to stop the bank bashing continuing and this to be ratcheted up?
Well, I'm concerned about that. Particularly, you know, if there's a change of government in May, and it's quite possible that the Labor Party may increase the existing bank levy, which is substantial. So the current bank levy of 6 basis points is not insignificant. That's for sure. So you know, if that was doubled, for example, or a big increase, that would have an impact on bank profitability and particularly bank dividends. So in that scenario, bank dividends would certainly wouldn't go up as much and could potentially fall. Well,
look, it's very interesting. Carry on, Nick.
I think that is the danger of this. The politics, to return to the politics of this for a moment, obviously for Bill Shorten there is no real downside in continuing to hammer the banks and going harder every time the coalition tries to introduce something. He, of course, introduced its own $30 million last resort compensation scheme with AVCA. That's not hard enough, according to Bill Shorten. He continued to push last week. I noticed tweets about Andrew Thorburns' golden handshake. So, you know, it's never enough as far as Labor is concerned, and there's no real political downside for them in that at the moment. The risk for them, however, is overreach.
And it was the right thing to have some sort of fund, because the original bank levy didn't do that, did it?
No, and strangely enough, when there was discussion around an original bank levy, a lot of that discussion was that would go to fund, you know, a kind of victims' compensation fund, which it just kind of disappeared into the budget budget bottom line, conveniently enough. So it's not a bad idea at all. But I think the problem for Labor is overreach. If they keep pushing, there are unintended consequences, and it could make them look a bit silly.
I agree. Leo, I agree entirely. I mean, it's the unintended consequences, and in opposition they can bash as long as they like, but this is serious. You know, these have serious widespread economic ramifications across the economy, and we must maintain a strong financial system, a strong banking system, and the four major banks are cornerstone, are key to the Australian economy. And I've said many times before, we haven't had a recession in 27 years or so. You know, Australia is one of the most wealthiest countries in the world. Well, we don't want to blow that up by weakening the major banks to the extent that that we do suffer economically, and that'll flow through to the politics as well. Because if the Australian economy goes into recession, what's going to go up? Unemployment's going to go up. House prices are likely to fall a lot more than they have. And you know, at the end of the day, the government of the day will be blamed for it.
Yeah, so we've got this issue of business certainty. Now, look, before we've got a few things to discuss. David, can I just ask you about your take on NAB and most likely successor in the job of CEO?
Yeah, sure. As you pointed out, it's a really interesting one. I think Craig Drummond, the current CEO at Medibank, I'm pretty sure is not interested in the role at all. So I would not include him in discussions. Bill, I think Mike Baird is the likely successor. However, of course, he hasn't had enough time in senior banking roles. So it wouldn't surprise me if Phil Cronican's acting CEO role is extended a little bit further, a bit further than expected.
And might he like to remain as CEO? Everybody keeps talking about him as chair, but maybe he wants to go at the crack at the title.
Yeah, potentially. Yeah. I mean, he's obviously very well regarded and has got a good experience. But I don't know, of course, whether he would be more interested in the chairman's position or the CEO's position. But I think Mike Baird's the likely successor. It's just he'll need a bit more time.
Leo, other people in the mix. There's Ross McEwen.
Yeah, well, look, I don't understand why. I mean, there was a pretty well-sourced report in the Fin this morning about, about a shortlist, but I don't see why Ross McEwen would come back at this time.
George Frazee is another name.
Well, this is a dark horse that's being punted around as well. He's obviously got extensive experience at NAB, but also head of a retail bank. He's got that retail experience. He's got good technical experience. Would he risk going in at NAB, maybe, for the top job?
Yeah, well, that's really interesting. Finally, David, can I just ask about QBE? Because they were pretty specky results, weren't they?
Yeah, there was the actual headline number was actually a little bit softer than we were expecting. Investment returns or investment income was lower, not surprisingly, with that really weak November-December period in equity markets. But I think the core, I mean, reading through the headline number, there's a lot of good things going on at QBE. Not the least, they're benefiting from the global increase in premium pricing. So QBE reported today an average of 5% globally in their premium rates. So that's a positive, and the momentum's good going into 2019. But it's not just that; it's the improvements in the underlying business that Pat Reagan has introduced and implementing and driving hard. So I think we'll see better results, stronger results going forward. But however, I have been saying that for a number of years.
All right. Well, we'll see how we go. Might come good soon, I think. Thank you very much, David Ellis, and also Leah Shanahan. Good to speak to you both. After the break, we'll get across today's BlueScope result with CEO Mark Vassella next.
You're watching Ticky on Your Money. Now, back to Ticky.
Welcome back. Well, let's go to BlueScope because it pulls in a lot of issues at the moment. Soaring steel prices saw the company post a record first half profit of $624 million, up 42%. Underlying profits up 88% to $614 million. Looking to the future, BlueScope will focus on growth in its key markets, including India, the ASEAN nations, and very importantly, North America. Overall, the business is forecasting for softer earnings in the second half of the year, with underlying full-year earnings up 10% year on that year. Shareholders will receive an interim dividend of 6 cents a share. Well, to unpack those results and a few other issues, I spoke with BlueScope CEO Mark Vassella a short time ago. Mark Vassella, thanks for joining me. Now, record half-yearly results, and your jewel is now your 100% owned North Star, I guess.
Yeah, no, look, it's been a fantastic result out of North Star. We had a half with really strong steel prices. Part of that was driven by the trade actions that were taken. But the team at North Star have done a terrific job. So, yes, we're pleased we now own 100% of that asset.
So the trade actions that were taken by Donald Trump, is that what you mean?
Yeah, so the Section 232 no doubt had an impact on pricing. We've seen that moderate back. So towards the end of the half, certainly prices have come back to more normal levels, but in the first instance they ran up very high. But the moderation is bringing them back to levels that I think are supported by the supply and demand balance and the strong underlying economic conditions in the US.
Yes, so your full year, your outlook for the full year is still, what, a 10% increase?
Yes, so FY19 over FY18 we expect about a 10% increase. Last year that was $1,269,000,000. So a good result. We'll have a softer second half because the first half was very strong, but still a good year-on-year improvement.
Interesting for our viewers is that we hear all about the housing market being very soft here in Australia, and indeed sort of softer statistics coming through in the US as well, and yet it doesn't seem seem to have hit you in the same way that it's hit some other companies. Now, is that because of the infrastructure boom?
Well, there's a combination of factors there. We don't have a large exposure to the residential market in the US. It's mostly commercial and industrial, so that doesn't really impact us in North America. In Australia, when you read the statistics and see the headline numbers, if you unpick that a little bit, you see very, very significant slowdown in apartments and high-rise construction, not nearly as much of a slowdown in detached housing. That's the space that we operate in. So our ColourBond products go on the roofs of houses, they go into the alterations and additions that occur at the back of someone's house or when someone puts a second story on. We have a very small exposure to the high-rise apartment market, so we haven't seen as much of a slowdown because we don't have that exposure to the apartment market. Having said that, there's no doubt there is a slowing. It's coming off high levels, which is good. Our overall levels of demand are still really strong.
And more broadly in the Australian market, your outlook?
Correct. So infrastructure continues to be a strong spend. You only have to look at the major cities on the East Coast with road and rail and tunnels and bridges. Our more commoditised products are strong in those areas as well.
Mark, looking at your big spend coming up potentially, early to mid next year, that's back in the US. You've already put 50 million down towards it. Now tell us about what this investment will deliver.
So this will allow us to accelerate the program on the basis that we...
At Morningstar.
Correct. On the basis that we proceed with the project, this will allow us to accelerate the program. So in some ways we're taking a bit of a bet on the $50 million, but the early indications from all of the work the team have done, and it's been extensive, is fairly positive.
And what are the factors that will influence whether you go green light this decision?
So right now we're finalising the capital equipment spend, so the large contractual pieces for the various bits of equipment. We're working on raw material supply, on our sales mix, also some environmental requirements and permits that we're working on. But at this stage, the indications are quite positive.
Right, so that would come through, as I say, early in 2020.
Yes, that's correct. Correct, yes.
Can I jump back to Australia? There's been a lot of talk, I think, driven by the Financial Review, about your thoughts on iron ore supply for Australia, for Port Kembla in particular. Now, there's been some suggestion your BHP supply contract is coming to an end in June. Where are your thoughts now?
So we are coming to the end of what was a 17-year contract. So a very unusual contract, okay for the time when we spun out of BHP, and iron ore supply and surety of supply was critical to us as a new listed entity. But the world's moved on, and iron ore pricing, as with coal, is now very much priced on a spot basis. It would be unlikely, even if we wanted to rewrite a 17-year contract, that we'd be able to. No one would want to take that on. So we're just coming to the end of the contractual arrangements with BHP, and we're talking to BHP and all of the other domestic suppliers about where and how our iron ore will be sourced going forward.
You've brought Vale into that beauty parade all the way over in South America. Now, how much of that has got to do with this attack by the unions on BHP in particular for laying off, 80 maritime workers?
Yeah, it actually has nothing to do with it, Ticky. I was as surprised as anybody to read the article on the weekend, quite frankly. We, for many years, have taken small parcels of iron ore from other countries and other suppliers. It's about the mix of raw materials that we put in our blast furnace. The vast majority of iron ore under our current arrangements comes from the Pilbara. I would imagine that going forward we will continue to be supplied predominantly by Australian iron ore suppliers.
So, for example, if it's FMG or BHP or indeed Rio, one of those three, it's still got to ship it round to the eastern states. Are you worried at all that this pressure from the MUA, potentially through industry super funds, will actually impact on, companies like BlueScope, who are choosing to use Australian companies who do not employ Australian workers? So, in other words, this could go along the supply chain to hit you.
Oh look, I'm at the end of the day, we buy iron ore, we buy coal, we buy fluxes, we buy all sorts of material for the steelmaking process. All of these commodities are globally and internationally traded. So we buy raw materials, and it's the supplier's responsibility to service us. We have very strong supply chain responsibility rules. We like to ensure that the suppliers that provide us with materials are meeting their requirements from a human rights perspective, labour rates, pay, etc. So that's a requirement of what we expect from our suppliers. But when we buy iron ore or coal or fluxes, we buy them on a delivered price. We're not a freight company. We've never run our own freight fleet.
But do you think it would get to, I mean, it would get to a silly level if, for example, the unions were pushing you because of your chosen transporter when it really has nothing to do with you?
Well, again, we have no control. So if we were to buy raw material from a supplier, it's really not up to us to tell the supplier who to use to ship it to us. In the scale of things, we're a tiny consumer of iron ore globally. There's hundreds of millions of tonnes shipped out of Australia, and we're just a few million tonnes that comes to the East Coast. So we really have no leverage or no control, or don't add any value in terms of getting involved in that supply chain question.
And what about your own relations down at Port Kembla with the union? I know Dan Walton who was part of the original great deal with BlueScope that kept the steel mill going. He, in recent months, has been, I guess, more upset that now that BlueScope is doing so well, that workers aren't getting enough of the upside.
Yeah, look, we've been working hard with our employees and Daniel and the AWU and the other unions that we deal with to come up with what we think is a fair arrangement. Much the same as we've just reported a fantastic result for the first half, and we're guiding to a 30% reduction in the second half. We operate in a volatile and a very competitive industry, so our efforts and our hard work is going to ensuring that whatever deals we put in place for our business are about the survival of the steel business in the long term.
Have you got a profit share in mind?
Yes, we do, and we currently operate a profit share plan, and one of the sticking points in the negotiation has been that we would like as many of our employees as we can to work on a profit share plan. So that means when things are good, everybody shares in the gain, and when things are not so good, everybody tightens their belts. So from that perspective, we think that moderation is appropriate in an industry like ours that's so cyclical.
Mark, are there any other issues? Here we are in the middle of an election campaign, a lot of very trigger-happy decisions being made, I think. Any other issues that concern you? There was a court decision recently on Rocky Hill as far as coal production is concerned. Equally, as I say, there are decisions around electricity supply. Anything keeps you awake at night?
Oh, look, I worry about decisions that get made in haste. I'm not an expert in the coal industry, so it's hard for me to comment on that. We still pay too much for energy in Australia. Unfortunately, we don't have a coherent energy strategy yet in this country, and that impacts businesses large and small, and retail and residents. So I do worry at night about the fact that we're still paying way too much for our energy in this country.
Finally, for investors, you've got a share buyback and you've got a dividend. How should investors see the company going forward?
We try to be really clear about this, and we have a stated policy around our returns to shareholders. We don't have any franking credits, and universally investors tell us they don't like unfranked dividends. So we've used the buyback as a method to return capital to shareholders. We think it works effectively and well, but we will continue to be prudent around our balance sheet. One of the lessons we've learnt as we went through the ups and downs as an organisation is having a strong balance sheet is critical for a business like ours, so it's something we will guard jealously.
Well, Mark Vassella, the market certainly liked it. Investors liked it today. Congratulations on your first half.
Thank you very much.
After the break, the government unveils a climate solutions package. We'll get the details with the Minister for Energy, Angus Taylor.
This is Ticky on Your Money, covering the big business stories.
Welcome back. A big announcement. Prime Minister Scott Morrison has resurrected Tony Abbott's Direct Action Fund today as his government seeks to calm coalition voters concerned about climate change. The rebranded Climate Solutions Fund is aimed at ensuring Australia meets its 2030 emissions reduction target by funding farmers and small businesses for projects like revegetating land and replacing inefficient energy appliances. Speaking to Sky News, the Prime Minister has denied suggestions the $2 billion of taxpayer funding amounts to a price on carbon.
Did you concede this morning that $2 billion? It's a big figure. This is a carbon price, isn't it, of some sort on the economy and on taxpayers?
No, this is an investment in programs which is doing everything from better soil prep. It's in the budget. This is the point. It's in our budget.
It's a carbon price.
It's fully funded. No, it's not. It's not. I think that, with great respect, Kieran, shows a misunderstanding of the issues.
Well, Mr Morrison's pre-election pitch will also serve to highlight the cost difference between his government's 26 to 28% emissions reduction target compared to Labor's 45% target.
Our target is no slouch. And let no one tell you it is. It's a fair income commitment. It's a serious commitment that requires real effort to achieve. But nor is our target reckless, nor is it extreme. By contrast, Labor is proposing a 45% emissions reduction target. Makes the carbon tax look like a mosquito bite. This thing is a chunk out of people's living wage.
So a Goldilocks target from government. Labor has slammed the direct action approach and isn't ruling out scrapping the fund if elected.
New name, same failed approach.
Are you saying Labor's going to scrap it if it wins the election?
Well, we'd obviously have a look at it, but we've always been sceptical, as indeed has Treasury. So Treasury law says that a third of the projects would have happened anyway, and the effective cost of carbon abatement is $80 a tonne, which is way higher than most other ways of reducing carbon emissions.
Well, for a little more on that announcement and also broader energy policy, I spoke to the Minister for Energy, Angus Taylor, a little earlier. Minister, thank you so much for joining us. Now, big announcement from the Prime Minister today. Now, what is this Climate Solutions Fund, and is it not just a rebranding exercise for the Emissions Reduction Fund?
Well, no, it's much broader than that. The package actually includes a range of initiatives, Ticky, including a strong focus on energy efficiency initiatives, hydro initiatives, which are badly needed in a grid right now where there's an enormous amount of intermittency coming into the system. But it also includes an extra $2 billion of funding for the ERF, the Emissions Reduction Fund, which has been a phenomenally successful fund, a very low-cost way of abating carbon. It's averaged about $12 a tonne, which by domestic or international standards is near unrivalled. So that is an important part of the package, but the entire package puts us in a position where we can be very, very confident that we're going to reach our 26% emission reduction obligations, and it's an important part, I suppose, of demonstrating the credentials of this government on targets, international targets, which are strong by comparison with other countries.
Yep.
The contrast is Labor with a 45% target, which we think is ridiculous, unachievable, and will have very significant impacts on business and enterprise in this country.
Aren't, though, Australians entitled to be a little cynical about this move? I mean, after all, the Prime Minister has said in the very recent past that you should be able to reach the emissions targets that the government set in a canter. What's changed?
Well, we're going to reach our 2020 Kyoto targets in a canter over 360 million tonnes, over and above the targets for Kyoto, and we're confident that we'll reach the Paris targets in a canter as well.
But
these are initiatives.
Isn't this response more as a result of the rise of, say, Karen Phelps and indeed Zali Steggall?
No, this is just sensible policies, which are very, as you rightly pointed out, they're similar, not the same, but they're similar package to policies which have worked in the past in terms of achieving Kyoto. Look, there's very few countries in the world that can claim what we claim with respect to Kyoto We are putting together, we have here in the announcement today, a similar package of policies that will get us to the 26% target using proven policies that we know are going to work, Ticky, and we make no apology for that. They're low-cost policies. They'll have minimum impact on the economy. And the contrast is much higher targets, which we think are completely inappropriate, well beyond what other countries are doing. And you know, the Prime Minister was very clear that those are unacceptable targets, and they will be a wrecking ball for the economy, as the Business Council itself has pointed out.
All right. Well, let me go to something which some companies in Australia in the energy sector feel is a wrecking ball that you're throwing around, and that is over the default market offer, which now, as a result of the Australian energy regulator, is now a cap, as everybody feared.
Well, it is a cap for standing offers. And let's be clear about this. Less than 20% of households are on standing offers, and about 20% of small businesses are on standing offers. So it's a relatively small proportion of the market that's directly impacted by that cap. And there's no cap on market offers, Ticky. But what there is here is also a reference price, which will make it much easier for customers to choose. Now, it's true that if you're a big energy company, competition doesn't necessarily help your bottom line. That's the reality. But we want competition. We want a fair deal for customers. We want customers to be able to compare the offers that they see across multiple companies, apples for apples. A 20% discount should be comparable with a 25% discount versus the same benchmark, the same reference price. That's what this does, and it does cap for that relatively small proportion of customers. Although you know it totals up about a million overall, but that relatively small proportion of the market, it does provide a cap, and the reason is they are the most vulnerable customers. They're the customers who are not in a position to shop around, or simply don't have time to shop around.
Yes.
And we have seen in the 4 years between 2014 and 2018 in Victoria, for instance, a doubling of the premium charged to those customers. Now, as Rod Sims at the ACCC pointed out, the big companies could have done the right thing themselves on this.
Yeah.
They haven't, and so
now,
the government has acted.
What about the argument? Because I think some energy companies would argue this is not increasing competition, this is intervention. What about the argument this will reduce the discount offers that already exist, and that in a way this will hit people who really are struggling, and their struggle has forced them to look for the discounted offers, and you're actually going to be hurting the one lot of people who really have tried to get lower prices?
Well, we disagree with that, and the ACCC strongly disagrees with that. The ACCC is the one that made the recommendation to go down this path. They used the comparison of the UK market. In the UK market, 60% of customers were on standing offers. That's not true here. So, you know, it's a very different market in the UK. We think this is completely appropriate. And look, at the end of the day, Ticky, what we've had in this market is customers getting offers from different companies that are completely incomparable. You couldn't compare one with the other, and they're designed to confuse. What we're doing here is making it simpler for customers to choose. Now, it's true that mightn't be good for companies' bottom line, the big energy companies' bottom lines, but it's fair and it's appropriate given some of the marketing tactics that have been used in the past, which are completely inappropriate.
Angus Taylor, why did you react so almost viscerally to AGL's results this half year? I mean, yes, they made a profit. You said Australians should be outraged.
Well, because the companies should be doing the right thing. I mean, we shouldn't have had to do what we've done here. It's not like they're selling iPhones. These are not products that are innovative, new. There's not a massively growing market. The sort of circumstances where you expect rapid profit growth. It's not one of those circumstances. The ACCC has pointed out very clearly that the conduct in this market has been unacceptable and unsustainable. Their words, not mine. Unacceptable and unsustainable. And the right thing would have been for the companies to see that and to step in and sort it out. Well, they haven't, and that's the disappointment for me, Ticky.
But why?
It's very clear this hasn't this market hasn't worked as it should have.
Yes.
The disappointment for me is that companies actually haven't taken it upon themselves to fix it. And in a modern environment, I think, you know, focusing on the customer and doing the right thing is absolutely appropriate. And if you don't do that, some combination of competitors and regulators will do it to you. But
you of all people, people understand the complexity of running a business. Now, on that day, AGL shares, I think they dropped 5%. The company warned that the second half, you know, there are two halves in a year, would be much tougher. There'd be more upkeep costs on power stations. There'd be lower gas sales. We all know that, you know, profits can happen in one half, and then, you know, full year it can be quite different. And I'm just wondering, are we getting to a stage where really between Labour and the government in this election campaign, it's really who gets the Oscar for bashing business more? Is it actually a situation where particularly customer-facing businesses really can't be making too much of a profit, period? Doesn't matter whether they make that profit from being more competitive or more efficient, they just can't be seen to be making a big profit.
Now, look, Ticky, this is a very specific market, and we, you know, I've spent my career in business, as you know.
Yeah.
So, you know, I know what good behaviour in a market is, and I know what bad behaviour in a market is. And you know, generally speaking, businesses in Australia do the right thing. They really do. They do the right thing. But this is a circumstance where the ACCC itself has come out very strongly in a very strong report and said the behaviour is unacceptable and unsustainable. And as I said earlier, it's not as though there's been a whole lot of innovation or new products or services that are driving the profits here. There's just been price hikes. Now, this is a service which is different from most. It's bought by almost every Australian. It's a very basic service. It's one we all rely on. And so there's a special responsibility here, particularly when you remember that three players in each market control at least 70 to 75% of those markets. So there is a sense of responsibility that needs to be carried in this market that is different from some others, or many others. And that's the point I make privately and publicly to the companies. There needs to be a response to this ACCC report, and as I said, we've decided to act on the default market offer and the reference price, two initiatives we announced on Saturday, because the energy companies weren't doing it themselves, so we've stepped up.
All right. Finally, can I ask you, Minister, about basically you haven't got your big stick legislation through. You chose not to because of the amendment that involved coal. When it comes to your underwriting of the new generation investment plan, which could, I understand, include a new coal-fired power station, potentially. How is that going? And is this idea of a backlash, you know, from the Australia Institute says you could be open to constitutional challenge at the moment in terms of your powers to deliver it?
Well, let me just pick you up on something you just said a moment ago. The legislation that we've put has been introduced to the Parliament, it's been voted on a number of times, is still on the notice paper. We would like to get it through before the election, but 11 times or 12 times Labor has voted against it. We want to see it go through. It's based on recommendations of the ACCC around market manipulation and closing down of critical markets. It's dealing with those issues that the ACCC identified and recommended on. So we want to see it through.
But they didn't recommend you use a big stick like this, did they?
Well, but the problems that were identified in the ACCC report, and which they recommended we act on, are what this legislation is about. Now, the big energy companies don't necessarily want to admit that, but the ACCC recommended we act on market manipulation, that we act on the closing down of the market, the barriers to entry that have been created, for instance, in the South Australian market. Coming back to your second question, which is the underwriting new generation, the ACCC recommended that this be a technology agnostic approach, that we shouldn't focus on any particular fuel source. We should focus on dispatchable power, bringing new, reliable generation into the market at a time where we're seeing record investment in intermittent power. We are following the approach recommended by the ACCC. We're confident it's constitutional. We'll have the legislative authority we need. And we got 66 proposals come forward, an enormous amount. There's great interest in investing in this industry, Ticky, despite claims by some to the contrary. And we're working our way through those proposals as quickly as we can. It's a lot more than we expected, so there's real work to be done as we work our way through them.
Well, that is good news. Minister Angus Taylor, I'd like to thank you so much for taking the time.
Thanks, Ticky.
Yeah, it's rather a tricky portfolio, isn't it? Now, a development in the gas sector that we've been following, the fate of Narrabri, which is this hugely controversial gas asset owned by Santos that is waiting to develop it. Now, we're just, 4 weeks from the New South Wales election, and in the last 24 hours, here's Labor opposition leader Michael Daly out in Coonamble with some locals.
That's why I've told the community today that if I become the Premier, in just under a month's time, we will stop this project. We've never supported it. We don't support it today. We've been fighting against it for years. No one should be surprised by this announcement today. It's a continuation of our policy. We didn't support it then. We don't support it now. We're with the people of Coonamble.
Well, Michael Daly said no one should be surprised. I think there were a few people who were quite surprised. First of all, Santos boss Kevin Gallagher, who we spoke to last week, he had a bit to say about it today. He says, look, it's very important to us that the environment and water resources are protected. New South Wales has a very strong environmental regulation to ensure Narrabri can be developed safely and sustainable. 100% of Narrabri gas would go into the domestic market, potentially supplying up to half of New South Wales' natural gas demand. If the state doesn't develop gas resources, then the people of New South Wales will pay for more gas and will pay more for gas and electricity, and manufacturing jobs will go elsewhere. If New South Wales doesn't develop gas resources, then the people of the state will pay, yes, as I've said, more, investors will also go elsewhere if the rules keep changing after investments are made. Well, now, it's not just Kevin Gallagher who's out of sorts in this. The union is said to be seriously displeased by Michael Daly's electioneering stand. And joining me for his take is top gas analyst at Credit Suisse, Saul Kavonic. Saul, very interesting development. Now, you alluded to the importance of Narrabri and to manufacturing the last time we spoke. This must have been a bit of a surprise.
Yeah, well, we touched on the precarious situation that this project is in last week, and as we head into the election, because the state seat that Narrabri sits in, held by the Nationals, is actually now in contention due to the Murray-Darling water disaster situation. And so what we're seeing here is that risk has been realised, where the shadow opposition leader has essentially succumbed to a populist rhetoric here in order to try and push those votes over the line up in that seat.
Did he check with anyone before he marched out there, put his position down, do we think?
Look, I mean, you can see over the last few weeks that there's obviously been a lot of lobbying going on behind the scenes in order to try and land a position, or more importantly, perhaps to not land a position before the election, to try and keep options open after the election. So we saw, that's why Kevin Gallagher, the CEO of Santos, came out, for example, decrying LNG imports as not a viable alternative to developing onshore gas fields. And particularly we saw the Santos results last week. Kevin mentioned the potential for actually hope for new manufacturing jobs in New South Wales.
Now, who would he mean there?
Well, I think we could highlight a couple of areas. I mean, one is an existing customer, Quinos, could be looking to potentially expand operations at the right gas price.
So they're polypropylene?
Yes, plastics manufacturing in essence.
Yeah,
and
in
also,
New South Wales.
Yes, and potentially you could see new areas, for example, in ammonia or fertilisers.
So that's new jobs.
Yeah, well, it flies in the face of the whole narrative of right now. High gas prices are killing jobs in manufacturing on the East Coast. So that suggests to us that Santos is actually maybe considering signing gas deals at subsidised gas prices to underpin new jobs to try and get political support behind this project. Yeah. But that obviously hasn't worked in this particular instance because the populist measures kind of approach, the tactics heading into this election have seemed to have trumped those potential wider agenda. So perhaps we could see something more from Santos or others trying to steer this conversation in other directions. So has this kind of wedged
the left a bit? Because I'm just wondering, I tried to contact the AWU, Dan Walton, today. Look, they're just sucking on this, but presumably they're really angry.
Well, when we're talking about jobs here, very specifically, we're talking about unionised manufacturing jobs, which is the Australian Workers' Union's jurisdiction. And I believe Dan Walton, the head of the AW, has been on your show before.
He has, yes.
Stating the AW's policy, which is pro-gas development, pro-Narrabri development, to underpin their members' jobs. And so what we have here is a Labor leader essentially coming up with a position in directly contradictory to the AW's position. And we think that, you know, that could actually be costing Michael Daly some political capital in the longer run in order to get this kind of populist short-term measure
I noticed he's in a bit of strife in the papers today over sort of alleged sort of donations and property development and that sort of thing, which of course he all denies. But I mean, he's not sort of safe at the moment. There's all sorts of things going on. So you'd think that getting the support of union backers would be crucial.
Indeed. Well, we'll see how this will play out. I imagine, you know, there'll still be some patience involved, and we probably won't see any changes for an election. But I suspect this would cost him some political capital in the longer term.
All right. Santos's results, I haven't had a chance to talk to you about them apart from Narrabri. How do you see them?
Overall, a solid result. A couple interesting things to point out. I mean, one is you're actually starting to see the changing gas market dynamics benefiting Santos from their existing infrastructure positions, where you're seeing increased processing revenue. The gas swap deal they did with Shell to enable Shell to increase its trading, Santos is actually getting some of the benefit of that because they provided the gas swap infrastructure. Right. The other one was they finally came out with some more material numbers for the Quadrant acquisition, and something we highlighted a risk with that acquisition was the abandonment liability. Indeed, when Woodside acquired all of Apache's assets a number of years ago, they deliberately carved out the Quadrant assets, we suspect because of the abandonment liability. That abandonment liability is now coming at close to $900 million. And where the risk is around this is there's still quite a high degree of regulatory uncertainty regarding abandonment liability, where we could see, for example, NOPSEMA could require anything from your offshore platform being completely decommissioned and removed.
Really?
Or it could just allow it to stay there, for example, as an artificial reef. And the difference in cost is an order of magnitude. And so that's now a liability and an uncertainty that sits with Santos, for better or worse.
Along with that growth potential.
Indeed.
Right, OK. Saul Kavonic, very interesting. Thank you very much for joining us there. After the break, we'll get a Brexit update with CEO of the Australian British Chamber of Commerce, David McCredie.
Now, back to Ticky.
Welcome back. Well, let's finish with Brexit. British Prime Minister Theresa May has bought herself some more time to negotiate this divorce deal with Europe. She confirmed she won't be bringing a new divorce deal back to the House of Commons for this final vote this week. Instead, Mrs May promised a vote on March the 12th, just 17 days before Britain is set to leave the European bloc. Mrs May's proposed divorce agreement was rejected in an overwhelming defeat in the Commons a little while ago. The Commons will vote on plans for what happens next on Wednesday, including one proposal that's expected to force Mrs May to ask the EU to extend the March 29 exit date if no deal is reached by March the 13th. But the country's opposition leader, Jeremy Corbyn, has fired back, saying the Prime Minister is putting the country at risk by recklessly running down the clock. Well, for more, David McCredie, CEO of the Australian British Chamber of Commerce, joins me live at the desk. David, thank goodness we have you to comment on when we've got these funny hours with Britain, because, I mean, really, this is going to be kicked down the road, do we think? Do we think there'll be this delay?
Well, it's interesting. I guess this is one of the options that we've always talked about, that an extension to the Article 50 process might be there. But then again, last time I was here, we were talking about the Prime Minister saying we've got to hold our nerve. And
well, Donald Tusk would like a 2-year delay, I notice, which effectively means that we stay in Europe. If we are British, yeah.
Well, if we are British, perhaps. But look, I mean, part of this is if there is no deal, we obviously have that hard edge that we are feeling quite strongly at the moment. And there are a huge number of people across Whitehall who are leaving their regular job to focus on how the UK would deal with a no-deal exit and getting themselves prepared.
That's finally really ramped up.
Oh, absolutely. That's really going ahead in leaps and bounds, and there are a number of colleagues that I've known for years in various roles who are taking on those. And presumably
on the other side of the border as well, in Europe as well.
Well, you'd imagine so, yes.
Yeah.
Although the EU bureaucracy has quite a good number of people to look into these sorts of things, one would imagine.
So what do you think of the allegation that the Prime Minister is deliberately running the clock down for a no-deal exit?
Well, I think the problem that we've got is, so from what we understand, and nothing's been as clear or transparent in the last week or so as it had been perhaps even going back a few weeks. We remember famously the French President saying no to the idea of removing the withdrawal deal and reopening the transition arrangements. The Prime Minister has been working on a legal codicil to try and get past that issue and to have an end date of some description potentially that would
solving the backstop.
Satisfy the backstop issues, which if you go back to the votes...
That doesn't seem to be working though, does it? I mean, she hasn't come back with anything yet.
She hasn't got that yet, which is part of the reason why there's probably not a huge amount of reason for her to rush to have a vote when she hasn't got anything new to put on the table.
So meantime, what is the risk of that vote coming back which would give Parliament power over the executive, the government executive? So
this is the Cooper-Letwin now, and it was Cooper-Bowles, now Cooper-Letwin arrangements. The risk is there. It's going to be a very interesting idea because that's hundreds of years of UK parliamentary rules that set the government of the day, set the agenda.
And not just on Brexit. There could be decisions on everything. Goes to the backbenchers.
Potentially, yes. So I think that's a very interesting question to see whether that would actually get up or not, because I think this is a unique set of circumstances around Brexit. I can't think of another issue where the backbench would actually try to pull this kind of stunt, for want of a better way of putting it.
David, in the meantime, there's been the most extraordinary developments with Labour shedding members, and indeed 3 have gone, I think, from the Tory party as well.
Yeah, that's about right, and they seem to be forming an interesting group of independents, which they're now calling the independent group in the middle. There's some interesting commentary on that from the Times and Spectator and other publications in the UK about what would an interesting central party look like. I think it's very difficult for them actually to make a party because I don't think there's enough issues that they're actually in agreement on. I think the only one that binds them together is, well, there's 2 bits to this piece. The Labor Party members have left partly because they can't see Jeremy Corbyn being a Prime Minister, but also most of them are very strong Remainers. As are the ones that have left from the Conservative Party. But I think when you look at both of them, both sets of people, and this is a broad generalisation of only 11 people, but both sets are very focused on that Remainer stance, but have, I think, very different views on a whole range of other issues. So it'd be hard to see them.
Finally, one option is that Theresa May does delay Brexit, but not so far as to the European elections, which happen in May. Otherwise, presumably, there's more chaos there because Brits all have to go back and be represented in the European Parliament. What are the chances of Europe saying yes to that? Because what will change?
Well, I think the hard part is there's been several weeks of high noon moments, as they keep calling it in the UK press, and the reality is until that moment actually arrives, which hopefully will arrive in the next week or 2, and there will be some certainty, until that point the ability to kick the can down the road has to remain in the Prime Minister's pocket. It does spring forward a whole raft of further issues, you're right, around European elections having to be held in the UK for new UK parliamentarians to sit in Strasbourg. There are a whole range of issues there as well, definitely.
David McCredie, great as always to get your analysis. Thank you very much indeed. And that's all for the show tonight. Tomorrow night, reporting season continues. I'll be speaking with Caltex CEO Julian Siegel and Afterpay Executive Chairman Anthony Eisen. Thanks for your company.